Hello. Well, you know the phrase, don't put all your eggs in one basket. But then again, did you know that there are very different baskets that you can put your eggs into? One is the sort of basket where you put your stocks and leave them, and the other one is where you have a bit of fun and you punt a little bit. There we say. Let's talk to Rahul Bhalla, who's the Managing Director of Vanguard Investments Singapore. What I just described as from the chicken yard is actually conventionally known as the core satellite strategy. Tell us firstly what the strategy involves.
Sure. So the strategy is really about having a low-cost index product, a diversified portfolio that forms the core of your investment portfolio.
That's what you put in there and you leave.
You put in there and you leave that. And then you sort of have the satellite where you take more of your active bets in the fund management space and you allocate across managers that you have a high conviction in. And mindful of the fact that 2/3 of active managers on average underperform the benchmark net of fees, and the 1/3 that do outperform are unable to sustain that performance over time. So in our opinion, there's a place for both passive and active in your portfolio. Having a core portfolio that's low cost, diversified, and indexed helps take some of the guesswork away from having to pick the right manager at the right time.
So when you say indexed, are you suggesting making ETFs, exchange-traded funds, that track indices, as the core?
Sure, yes. So there's a mutual fund version of the index product available, or you can have it in an ETF form. With the ETF, there's price transparency. You can trade throughout the course of the day. However, we tend to advocate the buy and hold to be in mutual funds and not be trading in and out. Because typically having a long-term view takes off some of the volatility that exists in the market. So ideally, the core should be in mutual funds and a long buy and hold, though you can do that with ETFs. The only problem with the ETFs is sometimes the lure of trading tends to dominate and most people can't resist it.
Yes.
That's less so with a mutual fund for which you only strike an NAV once a day.
That's right, and you have to submit the form to get your money out and all of those sort of things.
You absolutely do.
So that's the core, and then the satellite is what?
The satellite is around your high conviction managers. So if you feel you should be overweight emerging markets, or you should be overweight Europe, or overweight bonds, then that's where you can pick good managers that you think will add value over the next 3 or 5 years, or even shorter term, and then sort of allocate towards them, and then make sure that it's sort of in line with your broad asset allocation.
Now, could this also be individual equities?
It could. It absolutely could be.
And then how do you make that choice, which markets or which equities to track?
Well, it really sort of depends on where you feel you have the highest conviction. So that's sort of a little bit more on the tactical element, whereas the core is more your strategic. So the tactical bit might change given how markets are behaving and the news that's coming out of various markets, be it Cyprus or Greece or the US. Whereas the core should be an asset allocation portfolio that's taking into account all your asset allocation and then projecting out many, many years forward, and that's the money you sort of retire on.
Right. As you say, core and satellite, I'm imagining little planets floating around a big planet. But actually, how big should these planets be? In other words, should the core be quite a large chunk of your cash, with the satellites just being a little bit of fun money around the edges? Or actually, should the core be quite small and you allocate bigger chunks to the satellite?
That's a great question. So for us, it definitely should be, the core should be as large as possible.
70% of your assets?
70
80?
to 75% of your assets, and the satellite can be the balance.
Which isn't very much in the end.
It isn't a whole lot in the end. However, that's not the money. You don't want to gamble your money away on tactical bets. Because it's really hard to get it right. So it's hard getting in at the right time and getting out at the right time. And typically retail investors don't always have the discipline to be able to buy when it's really low and sell when it's really high. So on account of that, that core of your portfolio really is what's tracking your long-term performance and letting it grow, whereas the satellite really just adds that boost to it.
Right. You've mentioned this a couple of times now, the discipline, the emotions that come into play when you trade. And in general, we tend to say that you should either be a trader and do the technical analysis and have the discipline of watching the market every single day, Or you should be an investor where you put it away for 6 months, you don't let your emotions get in the way, and you really take a long-term view on a fundamental basis. But really, doesn't the core satellite strategy mix both? That you actually have to know both? And isn't there the concern then that you might get them mixed up, that you start trading your core or investing your satellite?
Right, absolutely. So I think the idea is you just take your core, you invest it, and you forget about it. You don't track how much your portfolio is every day. You can do that on the tactical element of it, the satellites. But again, the core is what's really going to drive your investment performance long term. Whereas with the trading aspect, like you said, that's the fun money. You can invest that, see how it really does. One of a line I really like to use is the quickest way to trade your way to 2 million is start with 3.
Right.
So that could, very
because
well
trading
happen.
does run the risk of losing.
Yeah,
money.
it's volatile. It could lose you money. The active manager that you've selected may not be able to deliver in time, and you run out of patience. And just when you run out of patience and you get out of it is when the manager's performance really picks up. And this is a challenge not just for retail investors but for institutional investors as well. When you've been losing money over a 3 or 4 year time period, can you have the discipline to say a couple more years to see them come up? And typically it's very hard to defend a manager that's underperformed the benchmark over a 4-year time period.
Right. You've been in Singapore for 5 years, so you know all about the CPF investment scheme and so on. Would it be fair to say that your core should come out of your CPF savings?
Absolutely. So that would be a great way to invest because of the way CPF is structured, to have some control on costs. Because for us, costs are very important, right? Anytime you're thinking about an index product or you're thinking about an active product, you really should be focusing on what costs you're actually paying all in. Because costs really eat into investment performance. It's especially so in the bond space. So you want to really have a strong idea of how much alpha should your active manager be delivering to you such that you are ahead net of costs.
Right. All right. Thank you very much. Great to see you, and thank you for explaining core satellite. And you can find out more about that during the Singapore Investment Week. The website address is on your screen now, and you can follow that to see where you can pick up a few tips and tricks about your investment strategy. Rahul, tell me about Vanguard Investments in Singapore. How is this associated with the US?
It is. So we are a sales and marketing office here in Asia. We currently cater to the South Asia institutional market and are particularly focused on the Singapore intermediary channel. And by intermediary, I mean private banks, financial advisors, and platforms.
Right, but you didn't talk about products just now. So can retail investors in Singapore actually buy Vanguard funds in Singapore?
Unfortunately not currently, because we don't have the licenses to do that. But we're hoping in a couple of years we'll be in a position to be able to offer our low-cost products to the market in Singapore as well.